I'm going to help fix your entries so you can go out there and take better trades. Now, there's a major problem hidden in plain sight with most entries of most traders. Now, let me explain. Because most tend to wait for the higher time frame to continue higher, to tell them a direction, then create a retracement back into any support level. That might, for example, be an order block, that might be a value gap, again, can even be support and resistance, any support level. Then what they do is for the entry, they go into the lower time frame to now look for a lower time frame potential reversal right here, to then hope for price to continue higher again. Okay, so then what's the problem? Now, let me tell you a quick story. By far, most of the losses that I took in trading is because I was trying to either call a top or a bottom in the market. So whilst the market was moving higher, I was trying to call a reversal right here to potentially continue lower, and the market just continued higher. Or whilst the market was continuing lower, I was trying to call a bottom, buy it right there, and would just end up being a loss, something along these lines. Now, you can probably already see where I'm going with this, because if we take a look at this example right here, what is exactly happening? The higher time frame moves higher aggressively, then afterwards moves lower, which causes the retracement. Now, whilst the retracement is actually still happening on the higher time frame, we start looking for a potential lower time frame reversal. Isn't that, well, I would argue, isn't that basically the exact same thing as trying to call a bottom at that moment in time? Because whilst we are potentially creating a lower time reversal, what is the higher time frame actually doing? The higher time frame is still continuing lower and still creating that retracement at that moment in time, taking you out of that trade, hitting your stop loss, and then even worse is when it eventually still continues higher afterwards. Now, why does that happen? At its most basic form, if you're looking to buy, isn't it a bit weird that you're waiting for a retracement and then to buy the retracement? Now, of course, that could work, right? There's some logic, there's some solid logic behind that, because you can potentially get a better entry, etc., etc. But where most people go wrong is then buying the first potential lower time frame reversal whilst the higher time frame is still creating a larger retracement at that moment in time. Now, why does this happen? If we take a look at the market, all the market, or the way I personally view the market, all the market is just momentum. So it has these multiple momentum phases. It has bullish momentum, it has bearish momentum, and sometimes it doesn't have any momentum at all, where it's consolidating. It's very similar to how momentum in general works in the world. So for example, a car. When a car is driving very fast, it's driving 100 miles or 100 kilometers an hour, and it's trying to go from 100 to 0, it's not going to do that in 0 seconds. It's not instantly, right? That's how momentum works. So no matter if you have the nicest car in the world, the most strongest brakes in the world, you're still going to have a delay. It's not going to be in 0 seconds. So it might, for example, be 5 seconds to go from 100 to 0. And that same car, if it's trying to go from 0 to 100, also won't be instantly, right? So again, no matter how good your car is, there's always going to be somewhat of a delay. Now think of how that translates over to the market. When the market is going lower very fast, again, it doesn't come to a stop and immediately reverses. You never see the market do something like this. Continue higher, immediately reverses, continues lower, immediately reverses, goes to the opposite end. It doesn't work like that. So oftentimes it's more like this right here. When we are continuing higher and price is trying to come to a full stop to then eventually reverse, just like that car is, then what tends to happen is we first tend to consolidate a little bit. Then we get some sweeps of some swing highs right there. We might still trade above those highs. And then eventually we still continue lower and we pick up that bearish momentum. Now, when we pick up the bearish momentum, the same. If that car is now trying to reverse again, is not going from 100 to 0 and then immediately reverse back to 100. No, it takes a while right there. It consolidates. It shows us price action that we might want to go back higher right there. And it still sweeps one more time. And then it continues higher right there and picks up the pace of that momentum. And you see that in price action itself right here as well. So we consolidate right here. Then we pick up the pace, the bearish momentum, to then continue lower. Here we're trying to reverse, consolidate. And now we sweep some lows and continue higher again right there. And that's essentially how these momentum phases in the market work, is that we need to go from bullish momentum to bearish momentum to then again bullish momentum. And that bullish momentum, again, it's not in an instant like that car reversing. No, it will take a while. So oftentimes, like in this example, when we do create the bearish retracements, which is bearish momentum at that moment in time, there's more bearish momentum than bullish momentum. Otherwise, there wouldn't even be a retracement. So when you think about it, inherently, if there's more bearish momentum at that moment in time than bullish momentum, and you're looking to buy, it's not ideal, right? When is the ideal time to buy? When bullish momentum is at its strongest, because that's oftentimes that results in those trades where you enter and it instantly hits your take profit if you're buying, of course. So inherently, you're somewhat forcing your will on the market, and the market is doing the opposite of what you want it to do at that moment in time. So whilst we are still creating this bearish momentum, that bearish retracement right there, we are trying to enter right here and be stubborn, essentially forcing our hand on the market and saying, well, this lower time frame potential reversal should hold right there and we should definitely continue higher. But all we're doing at this moment in time is we are still buying in a higher time frame bearish retracement. And to make that even worse, the signs are quite obvious most of the time. Because for example, here we still have this bearish fair value gap, which tells us a lot of bearish momentum is still in the market at that moment in time. So the market here is not ready to continue higher. So the lower time frame reversal right there, that entry confirmation, is very weak because the higher time frame at that moment in time is just going against you. And then it's not necessarily about what the higher time frame previously did right there, because previously the higher time frame told us that it did want to continue higher, yes. But what the market is exactly telling us at this moment in time is that the market is simply creating a retracement. So the bearish momentum at this moment in time is stronger. This is one of the first mistakes, and you could actually argue that that momentum misalignment is just a very basic idea of you're not having enough entry confirmation. Because again, in the past, I've also mentioned, for example, a sharp turn where you only need one fair value gap right there to potentially call a reverse to then continue higher. But using those in the right areas is very important to understand. So the solution to scenarios like this and how to eventually catch the winners is also things we're going to dive into. Because first, we need to understand that you can't go ahead and build a skyscraper on top of a foundation made up of chopsticks, because then sooner or later we're going to have a disaster and the skyscraper is going to fall. Now, what do I exactly mean by that? I think there's a hierarchy to learning about trading. Again, I think trading in itself is a skill you should learn, but within trading, you have multiple skills that you're also going to learn. So for example, one of the first things you're going to learn is bias, is direction, figuring out, are we going higher? Are we going lower? The second skill you might learn, for example, is context areas. Context areas are areas where entries are very likely to play out. Now, the third skill is, for example, entries. Then let's say the fifth skill is risk management. And again, there's probably a lot more skills that I'm not writing down at this moment in time. And then the actual fifth skill is, for example, psychology. Now, in the same way that you can't go ahead and try to fix your psychology when you don't know how to find a bias, how to find a context, how to properly find an entry, or even be somewhat remotely good at risk management, if you start fixing skill number 5 right there, your psychology, is not going to help you a whole lot because you don't even have somewhat of an edge before that. So first, you need to fix these things before psychology actually plays a factor, for example. But the same, for the same exact reason that you can't jump into trading and try to master entries if you don't know how to find a bias properly, if you don't know in which area you should actually be looking for an entry, a context area. Because you can have the most perfect entries. Again, you can have the most beautiful skyscraper. But if the foundation, the bias, the context is just simply not there, if you have those chopsticks that you're building on top of, everything will fall apart. So oftentimes, for example, when people come to me and they say, hey, Arjo, this entry did not work, or this entry did not work, oftentimes I'm not actually looking at the entry itself. I'm looking everything that came before that. Okay, why are you buying this instrument? Do you think gold is stronger than silver at this moment in time? Or should you have bought silver at that moment? The same, for example, with ES and NASDAQ. Which one is higher probability at that moment in time based on the higher time frame? Is your bias correct? Was ES indeed more likely to continue higher? That's why you looked for a buy. And then which area did you actually look to buy in? And if all those things are correct, only then I'll start judging a trade based on the entry itself. But if all those things are not correct and you have a decent entry, then the entry at that moment in time is not that relevant because first we need to fix the things that come before it. So that's something I want to work towards. Now, at the end of this video, we're also going to dive into the entries that I personally like using, but I first need you to understand where are we going to use that entry? Because understanding where you are going to use that entry is going to drastically improve your entries. So for example, our goal at this moment in time is to understand which area we can actually confidently look for an entry as well. That all starts with finding a clear target at first. When you have a clear target, you know exactly where you can start looking for an entry and where you can stop looking for an entry. I call that a boundary where you start looking for an entry and a target. And when a target is met, you stop looking for an entry. That gives you a certain area to work with. And in that area, you can then confidently actually start looking for an entry. So for example, here we might have the daily time frame. And on the daily time frame, I see that we are potentially sweeping this low right here based on that long wick. Now, if, for example, here I go into the 1 hour time frame. On the 1 hour time frame, I actually see that we are creating bullish fair value gaps right there as well. We are creating more bullish fair value gaps right there. Eventually, I see with these bullish fair value gaps right there and that we are coming from this daily sweep, I come to the conclusion, okay, well, I do think that these highs right here are going to be the next target. And after we reach this target, it might be this target right there. So I'm just marking out the swing highs that we have right there. Or for you, that might be any next resistance level that we can trade towards. So if I'm now looking for an entry, I know I can look to enter until we reach this area right there. After we reach that area, I want to take a step back again. I want to see what we are going to do. After that, I can potentially look for a new entry again until we reach this next area. So then I know exactly when I stop looking for my entry. But again, when do you start looking for your entry? And that's where the boundary comes in. Now, quite frankly, this is quite a straightforward answer because you start looking, if, for example, I'm looking for a buy. I start looking for my entry when I think there's no reason to create a larger retracement at this moment in time. And I think at this moment in time, we can only continue higher. Because think about it, if there's no reason to create a bearish retracement at this moment in time, then we have all the reason to continue higher, all the reason to buy. It's very high probability. So how do we know that? Again, this is where we're going to, again, dive into quite advanced material quite fast as well. I'm going to have links and descriptions to other videos as well that will absolutely help you with this topic as well. When there's nothing preventing us from continuing higher. So again, when there's no other resistance preventing us from continuing higher at that moment in time, there's no reason anymore to create a retracement. So for example, before we dive into the entry, that might be this swing high at this moment in time, because that swing high is again something that we can potentially sweep to then create a larger rejection. That's a possibility. It's a resistance area that we can create a larger rejection from. If we don't actually create a larger rejection from, and this swing high right there is not seen as a resistance area anymore, then what we can do instead is explode higher towards, for example, the next target. Then yes, we do have, of course, these swing highs in between right here, and we also have this swing high in between right there. Again, this idea is based on a trade that I personally also took, where we're using the 4 hour fair value gap right there, fair value area as well, disrespecting those to then continue higher. But I'm using the 1 hour right here, for example's sake, to make it a little bit easier to understand as well. I hope you can understand that. Now, this is where we now dive into the entry, because again, let's quickly understand what we just did. So we framed a target, understanding how far we can still look for entry. When do we stop looking for an entry? The moment we actually reach this line or get very close to it. And then we've also framed the boundary. So the boundary is again when we start looking for the entry. So we understand when we start looking for the entry and when we stop looking for an entry. And that, again, that creates an area, right? So this right here is, for example, as I like to call it, an area of opportunity. I understand the bias. Now I understand where I might take an entry. Now I can actually start going into the lower time frame to look for the entry. So what exactly do I look for? Well, if we need to overtake, for example, this swing high, that resistance area right there, I like to call this a two-sting entry. So if I go down a time frame right here, that's what I like to do. Just one time frame is enough for me. And the first thing I wait is the moment we sting, so we trade back above this swing high at that moment in time. Now let me use the replay tool just to give you this idea properly. The first time we sting above it, this is where I wait. Because oftentimes what we are going to do is we're going to create a larger rejection. If we don't create a larger rejection, my entry confirmation is simply not there. I'm not looking to get involved. Again, I also need you to understand that, because oftentimes what tends to happen is that they somewhat tend to ignore the entry confirmation and still look to get involved. That can work. In some scenarios, that can definitely work, but only if you really have the experience to pull that off as well, because oftentimes that just becomes a thing where you're now somewhat ignoring your entry confirmation. So you're ignoring your basic edge, and now you're still looking to get involved. Again, if your entry confirmation doesn't show up, why is that? Because your edge is not there, because your trading plan is not there. So you shouldn't take the trade because it's not high probability for you. And it's important. So here I wait for a larger rejection. Now, once we get the larger rejection, again, it's a two-sting entry model. This is the first thing right there above that high. And we retrace back below the high. Then what I want to see is I want to see a second sting with an expansion phase candle. Now this is objective. So I want to see a second sting above this high. I want to see a trade above this high right there again, but with an expansion phase candle. An expansion phase candle, very simply, is the second candle of a fair value gap. It sounds more difficult than it is, but essentially what it is a body closure right here. So a bullish body closure, if you want to see a bullish expansion phase candle, again, we're looking for a bullish entry at this moment in time, above the previous candle high. So again, this is a body closure right here above the previous candle high. For example, here, this right here, this candle did not close with the body above the previous candle high. So it's not an expansion candle. But this, for example, is again an expansion candle because with the body, it closes above the previous candle high. Once we see that above the high that we have right there, which would be the second sting, that's when I look to enter. Let's wait and see right here. There it is. There we have an expansion candle that also at the same time stings above the high again for the second time. So this right here is where I now enter on the future creation of a fair value gap. Again, when I hear myself say these things, it sounds so silly, to be honest. It sounds a lot fancier than what it is. Again, like I mentioned at the start, all this comes down to is essentially a momentum story. That's it. But I use these words to somewhat make it objective as well. So the future creation of a fair value gap. A lot to take in, but what does that exactly mean? Well, an expansion phase candle, like I mentioned, is the second candle of a fair value gap. Now, every 3 candles, there is a potential fair value gap creation. So for example, here, we have the first candle, we have the second candle right there, that expansion candle. Once the third candle closes, does not trade back to the previous candle high, then what do we exactly have? We have this bullish fair value gap. So that bullish fair value gap, like we understand it, is if we do create a bullish fair value gap right there, it is very likely that in the worst case scenario, that we do create a retracement, we can retrace back into the fair value gap right there to then still continue higher. So it's essentially protecting my overall trade ID in the case we do create a little bit of a larger retracement. So this is where I then cover the wicks right there, or sometimes what I also tend to do is I cover the bodies instead. But the reason for that is because oftentimes when we have this fair value gap, if the fair value gap does get created, we don't really have any more reason to retrace any further than the fair value gap to then continue higher, if that makes sense. So again, I am just purely looking at the future right here on what might happen in the case that we do create this fair value gap, etc., etc. Again, you might see right here, and that's exactly on this example, we don't even create the fair value gap right there, but we should create the fair value gap. That's just basically my whole ID, right? That's just my whole trading plan, my entry. So if we don't create the fair value gap, again, I'm already involved in this trade at this moment in time. Okay, well, it's not ideal, but again, it is what it is. I'm already in the trade at this moment. I target a 1 to 2 RR right there to then continue higher. And that's all I do. So I actually don't target the full target that I have right there. I just target a 1 to 2 RR. And I would also advise you to do the same thing, because oftentimes you will notice a logical target makes logical sense, as in we do ideally need to reach that target right there. But the market is the market, right? So oftentimes you also notice that when you hit your 1 to 2 RR, we don't reach the target, and all of a sudden we get a large reversal. It's just probabilities. So for me, I found 1 to 2 R is just a sweet spot. And at the start, just try to make a 1 to 2 R work before you start getting these crazy ideas on targeting a lot further. So this right here is an example of how I would take this trade. But if we now go back to that first trade that I showed you, because this trade right here requires a little bit of a different approach. And this is where I also want to dive a little bit deeper into that resistance, what we just talked about. But again, this is in a different format, right? Because now we're waiting for an actual retracement. You can see in my entry, in my trading plan, I actually don't really wait for a retracement. If a retracement doesn't happen, perfectly fine. I don't need to see a retracement. So right here, this is based on that 4-hour fair value gap. Again, support level that we can potentially continue higher from. If we now go into the 5-minute time frame right here, what exactly went wrong? Why is this entry not ideal right there? And why did it end up being a loss? Again, the momentum story, we understand that. But we also see right here that we actually have a 1-hour fair value gap right there going against us right here. So like we mentioned with the momentum, the higher time frame is still retracing. So you can have a lower time frame potential reversal right there. But as soon as we actually tap into this fair value gap, it's very likely that we're still going to create a larger rejection to still continue lower. Again, same as that car, right? When you have price going very fast to continue lower, it's trying to create a reversal. So it's trying to reverse and continue in the other way. We oftentimes will tap into fair value gaps, try to push lower from them, sweep some lows right there to then continue lower, higher, and then actually create the proper entry confirmation. And something for you as well, this is information that tends to happen extremely often. This is what I call an overflow transition, another fancy word, but it's lovely. I love that setup. I love this setup where we have a bearish fair value gap right there when we're looking to buy, so for higher prices. We actually sweep this low, and then the entry afterwards is a lot higher probability once we actually start running these highs right there as well, disrespecting the bearish fair value gap. So here you'll notice at first there actually ideally wasn't even an entry. So only if we start disrespecting the fair value gap by running this high right there, I'm going to have a video explaining that fully as well, then this right here is that same boundary that I talked about. And then this right here is eventually the target. So this right here, for example, is now our area of opportunity. Boundary where we start looking for our entry, and the target where we stop looking for our entry. Now let's say on Nasdaq and ES, you are more of a scalper. So you want to use a lower time frame. As long as you have that area of opportunity right there, you can get quite creative with the overall entry itself with the time frame alignment. So for example, here you can also go into the 1 minute time frame right there to then look for your entry. And purely the reason why that is because you have that clear area of opportunity at that moment in time. Now you can use the 2 stings right there, like I use it, or you could also wait for a proper fair value gap to form right there, or even wait, for example, for a fair value gap to get respected to then continue higher with this expansion candle right there. There's many things that you can do at that moment in time to then potentially look to get involved. Now, if you don't really want to think about that, I would just simply advise use the 2 stings like I use it. But the important part right there is that you have that clear area of opportunity. And when you have that context area right there, then diving into the lower time frame. And if you are a scalper and you trade futures very actively, for example, diving into the 1 minute time frame. And what you're then doing with those expansion candles is you're not entering whilst we are trading. So you're not entering against the momentum at that moment in time. You're entering with the momentum essentially. And of course, that doesn't always mean that the momentum will keep going higher, but you're entering at the right moment. So it makes it higher probability. And that's the point, to actually start putting this together properly and somewhat creating a trading plan, because you could argue this in itself is already a trading plan. I would highly recommend this video. That's going to help you a lot because it's going to build onto these ideas perfectly. All right, perfect. Thank you.